So traders that are still looking for opportunities to short into this market, this area was one area to watch: the 30-50, the 50-period simple moving average, and the 3200 area. This area, it's wide, I know, but this was the area I think a lot of traders were going to position themselves in on the daily to get short again. If you're not short now, based upon the movement lower today, I think a 15 or 30-minute swing trade would possibly be an alternative. So wait for prices to reach the 34-period EMA low or the 20-period simple on each chart. And short, if you get a between the greens opportunity, which we had pretty much all morning, that's fine. It's no longer valid now. For those of you that aren't familiar with the between the greens, you can check out the video that I have that explains how I intraday trade 5-minute time frames. So what I wanted to do here is hop into a view of the dollar and the Dow, because if the Euro US dollar really is going to take off longer term, there's got to be a risk environment. People have got to be thinking more along the lines of assuming risk, not running away from it. And for me, no two charts embody that better than the push-pull between the dollar and the Dow. So if we jump over to a daily chart of the US dollar and look at that, what we can see from here is that we're dealing with a transition of our own on the daily. So the downtrend in the euro is in transition. The uptrend on the US dollar index is also in transition. So when I'm dealing with these two transitions, again, that's where the confusion comes in. Do I remain a dollar bull? Do I remain a euro US dollar bear? Or am I simply going to be dealing with two markets that are respectively finding that their trends are now ending and that they're going to deal with volatile sideways chop? And in a volatile sideways chop, sometimes the bulls feel very justified for their bullishness, and sometimes the bears feel very justified for their bearishness. But yet when you step back and look at the chart, it's doing nothing but ping-ponging within a wide range. So is there a range that's been established here? I do think so. If we zoom in a little bit, I think the range that we're dealing with here is, you can see I've already identified and outlined these support levels that I'm going to be watching for potential buying support. And of course we have our high back here. So for now, I think we're going to bounce around in this range. I don't know that I'm going to keep my bullish attitude, because I think I've got to take away from all of this that the markup trend in the dollar may be over, or at least my grab candles are showing neutral. My sideways 34 EMA wave again is showing neutral, no longer an uptrend. So I've got to step back and say, yeah, I think that I've got to take on strategies that will allow me to take advantage of sideways volatile movement. If I want to trade this chart, I'm going to put a stochastic on it and look to fade. That means buy the floor and sell the ceiling, using a stochastic to recognize the overbought and the oversold, because my expectation is for prices to stay inside the range. I could do the same thing, by the way, on the euro US dollar. I call that a distribution fade strategy. I would only use this strategy in a market that I feel is moving in a volatile sideways range. I'd never do this in a trend. And the reason I can even entertain this strategy right now is that I don't feel that any longer we're in a trend. So let's jump over to the Dow. Now the reason I want to take a look at the Dow is because when I'm looking at the Dow, I'm looking at possible risk appetite and what's happening with risk. Well, we are dealing with a market, specifically speaking the Dow, that has been climbing up higher. But we also have a dollar that's been climbing up higher. The typical risk appetite view, if I am looking at a risk environment where people are willing to put money risk on the table, is the Dow heading up higher, the dollar heading down lower. We're not getting that right now, which means the risk picture is very convoluted. It has been for some time. I don't believe you can have a risk picture that has a dollar and the Dow moving together. That has not typically been the correlation, but it's not just about correlation here. We have to talk a little bit about causality. Don't confuse the two. You know, I was watching, I don't know if you guys have ever watched, I'm going to go off on a little tangent here, but it's really a great movie. You might be able to pick it up on Netflix or online. Freakonomics. Some of you might have read the book. They actually have a movie. It was awesome. If you can catch it, definitely watch it. It's well worth your time. What's the difference between correlation and causality? Correlation is, back, I forgot when they said it was, but there was a time before polio was under control that during the summer, kids would come down with polio, and polio basically incidence would spike. And scientists looked and were trying to look for something else that was spiking along with the polio incidence, and they saw that ice cream consumption by children also spiked. That's correlation. That's not causality. In other words, scientists said, well, maybe it's the ice cream, and ice cream is vilified. Okay, because they saw ice cream head up in the summer, they saw polio head up in the summer, they stepped back and saw the correlation and said, oh, that must be it. It must be something in the ice cream. That's correlation. Sometimes you have the causality. In this case, they did not. It was not ice cream causing the polio. Okay? I look for correlation, but I don't base my trading on it. I do want to look at those relationships. And if I can find within the correlations the causality, then I know I'm on the right track. And there was a time where running to the dollar meant risk aversion. Causality-wise, people took their risk money off the table and the Dow equities would head down lower. So they had an inverse correlation. Again, the causality, the common denominator here was the risk. Okay? So right now, I think those two elements are, I might have a correlation right now. They're moving together, aren't they? Sort of. But the causality really isn't there. I can't put my finger on it to say why the dollar and the Dow would be moving up together. That tells me the risk picture is convoluted and I want to step back. Okay, and make sure that I understand what's driving the market. And that, to me, when I think about causality, it's all about, do I know what's driving the market? What's the driver? Fear or greed? What's the driver? Risk appetite, risk aversion. And there were tools that we could use to do this. I think last year was a difficult year because there was a time we could use gold as a risk barometer. There was a time that I could use the yen to determine which was driving the market, the dollar or the Dow. Those things really are not as available anymore, are they? Okay, one of my favorite ways to determine whether the dollar or the Dow was the driver of the market was to see which one the dollar yen was moving with. Haven't been able to do that in some time. So when I can't determine the causality, the driver of the market, I will then try to find what it is that's driving. And right now I think we have to talk about headlines. We have to talk about nothing but Europe. And that's been the steady story for easily a year, right? So in terms of that dollar Dow push-pull, it's been difficult to put our finger on. However, I can still respect the trends that are on those markets individually without considering them in some sort of tied together, unison. I will recognize the transition out of the uptrend on the dollar, but yet that my Dow is still moving higher in what is easily considered some sort of uptrend here. Okay, so I will expect that when prices reach 20-period simple or 34 EMA high, they will be supported. Why is it important? We're Forex traders. Why am I looking at the Dow and the dollar? Risk appetite, risk aversion. What affects the dollar could certainly affect the relationship it has back to the pairs it trades against. And if I am going to expect that traders will step in and support the Dow here, I have to at least incorporate some risk appetite into my overall strategy and realize that that could eventually start to chip away at the dollar. Risk appetite will also influence crude oil, but crude oil has been dealing with a set of fundamentals on its own too. So rather than these markets moving like a set of well-machined gears, they're kind of moving independent and kind of crunching away at each other in a way that is not offering us harmony. And harmony is one of those things I love seeing in a market that moves well. The harmony between the risk appetite, risk aversion, push-pull of the Dow and the dollar, and the way that affects crude oil and commodities, so that I have a better view of what's happening in markets like the dollar Canada and in markets like the Aussie US dollar. We're just not getting that. And it's because of all these things happening simultaneously, that I think we're having a very difficult time determining what the market really wants to do.